At some point, someone told you that modern economies are safer than ever. More stable, more diversified, less risky, and on paper, that sounds right. Banks are better regulated, markets are more sophisticated, governments have entire departments whose only job is to prevent disasters. So here's the uncomfortable question. If the system is safer, why does it feel like you're the one absorbing more of the shock every time something breaks? Because quietly, over the last few decades, modern economies didn't eliminate risk. They relocated it, and a surprising amount of it ended up with you. Not because of a conspiracy, not because of incompetence, but because of how the system evolved to survive its own failures. Let's start with something simple. For most of the 20th century, risk lived in very obvious places. Banks took risks, corporations took risks, governments took risks. When those risks went wrong, the damage was concentrated. Painful, yes, but localized. If a bank made bad loans, it failed. If a company overexpanded, it collapsed. If a government borrowed recklessly, it faced default, inflation, or political consequences. But after enough crises, policymakers learned a lesson they didn't say out loud. Big failures are destabilizing, small failures are manageable, so instead of letting risk explode in one place, the system started spreading it out. Thin, quiet, everywhere. That's where you come in. Think about retirement. Decades ago, a typical worker didn't really worry about markets. Pensions were boring. You worked, you retired. The company carried the investment risk. If markets underperformed, that was their problem. Today, most pensions are gone, replaced by 401ks, IRAs, investment accounts you're responsible for managing. That wasn't just a cultural shift. It was a financial one. Companies didn't suddenly become greedy. They became fragile. Global competition increased, margins tightened, balance sheets mattered more, and pensions, guaranteed, long-term promises, were risky. So the risk moved from corporate balance sheets to individual ones. Now, if markets crash near your retirement date, there's no corporate buffer. No smoothing mechanism, just timing risk, and bad luck. And that same pattern shows up everywhere. Take housing. Homeownership is sold as stability, an asset, a cornerstone of wealth. But modern mortgage systems don't remove housing risk. They slice it up. Interest rate risk gets passed to borrowers through adjustable rates. Price risk gets passed to buyers through leverage. Liquidity risk gets passed to households that can't sell quickly without losses. In older systems, banks held more of that exposure. Today, it's securitized, bundled, sold, and redistributed. Which sounds sophisticated, until you realize the final absorber is often the homeowner. You don't just own a house. You own a leveraged position tied to interest rates, employment cycles, and local demand. And if those shift at the wrong time, the system stays intact. You take the hit. This isn't accidental, it's mechanical. Modern economies prioritize systemic stability over individual stability. That's the trade-off. Let's talk about markets. Every crisis now comes with a familiar script. Markets wobble, central banks step in, liquidity floods the system, rates go down, asset prices recover, balance sheets heal. From a distance, it looks like rescue. Up close, it's redistribution of risk. When central banks suppress volatility, they don't eliminate uncertainty. They compress it, push it forward in time. That encourages leverage. It encourages risk-taking. It encourages the idea that downturns will be brief and recoveries will be fast. But when volatility finally returns, and it always does, it hits the least protected layers first. Workers, renters, small investors, anyone without access to cheap credit or political insulation. Large institutions hedge, governments refinance, corporations issue debt. You don't. You face higher prices, job insecurity, portfolio drawdowns, delayed life plans. The system survives by letting risk leak outward. Even inflation works this way. Inflation isn't just rising prices. It's a transfer mechanism. When governments carry large debt loads, inflation quietly reduces the real value of those debts. Who absorbs the cost? People holding cash, people with fixed incomes, people whose wages lag prices. Inflation stabilizes balance sheets by destabilizing purchasing power. It's not malicious, it's efficient, and it shifts risk away from institutions that can't fail, onto individuals who can. There's a strange irony here. The more policymakers succeed at preventing catastrophic collapse, the more they rely on slow, distributed pressure instead. Instead of one big failure, you get constant micro-stress. Higher rent, more personal debt, less predictable careers, longer working lives, nothing dramatic enough to revolt over, just enough to normalize anxiety. And culturally, we internalize it. We're told to be financially literate, to diversify, to plan better, to hustle smarter, which is useful advice, within limits. But it subtly reframes systemic risk as personal responsibility. If your retirement underperforms, you chose the wrong allocation. If housing is unaffordable, you didn't plan early enough. If healthcare costs spike, you should have saved more. The system becomes invisible. The burden becomes personal. This is why modern economic stress feels so isolating. You're not facing a single villain. You're navigating a structure designed to survive by distributing pressure downward. And here's the part that's hardest to sit with. This approach works. Systemic collapses are rarer. Financial plumbing is more resilient. Crises are absorbed instead of detonating. But the cost is chronic fragility at the individual level. You live in an economy that's stable in aggregate and unstable in experience. Where GDP can grow while security shrinks. Where markets recover faster than people. Where risk is always managed, just not for you. So what does this mean going forward? It means the biggest economic danger isn't sudden collapse. It's quiet exhaustion. A population that absorbs volatility without ever releasing it. A system that survives by slowly transferring uncertainty to those least able to hedge it. A future where resilience is measured statistically, not emotionally. And the uncomfortable question isn't whether this system will fail. It's whether stability that depends on everyone quietly carrying more risk is actually stable at all.